Hello everybody and welcome to the Like a Tortoise channel. Today we have a session on the ins and outs of the income statement. This is probably one of the most sought after videos, certainly from members of our community and subscribers on YouTube. So I always share these videos with people that are in our community, but they wanted me to record one for YouTube. So here I am recording one today on the 20th of January, and hopefully we'll gain lots of value from it. Okay, so guys, this is going to be the first the first video of a series on financial statements. So this video is on the income statement. Then I will release three other videos: one on the balance sheet, then another on the cash flow statement, and then I will release another video covering how all these three statements actually come together. Okay, because this is important. You have to understand how they connect with one another, so you can make sound investment decisions as well. Okay, ultimately you guys have to understand that if you are looking to select your own investments, you need to understand that accounting is the language of business, and you, in order to be able to filter out all the shitty businesses from a handful of from a universe of companies, you're going to have to be able to understand the numbers. You don't have to be an accountant, but the more comfortable you are with the numbers, the better sense of them you will be able to make, and the more comfortable you will be in your whenever you are making investment decisions. Okay, the first thing that, so as always, I put everything together in a PDF. In these documents, I always share them with our communities on WhatsApp and also Skool. So if you guys want to join, it's entirely free. Just let me know and I will add to these groups. Otherwise, I'm going to have to create online documents to share these documents, and it's quite, I really can't be bothered, really, unless it's like a spreadsheet, something like that. But otherwise, like a PDF, I mean, come on. Okay, so bear with me as I walk you through the most important aspects of the income statement. So the first thing you guys need to understand is that we will be looking at, and by the way, we will be comparing two companies. One that I think has a good income statement, and another that I think that is not that good, that doesn't have a good income statement, which is, for example, Southwest Airlines, and the other one is Lululemon. So they operate in different industries, but the purpose here is for you guys to understand why I like to stay away from highly cyclical industries. And the reason is I just don't like the numbers. And as you probably know, what I'm after above anything else is I want to see some level of predictability and consistency in the numbers. All right. And with airlines, for example, I really can't see that. But it's not. This is not something confined to airlines. You have businesses that operate in good industries, and they have poor financial statements. Southwest Airlines is just an example of one that we will be covering in that particular industry. Okay, cool. So, first thing, the purpose of this document is to teach you how to read, interpret, and use the income statement as a long-term investor, not as a trader. The goal is to help you distinguish between high-quality, durable businesses and companies that only look good on the surface. I will tell you exactly how to look at the income statement through a Like a Tortoise lens, because you know that our philosophy focuses on long-term compounding, business quality over short-term noise, consistency, durability, and discipline. So, for those of you who are new to financial statements, what is the income statement after all? The income statement is also known as the profit and loss statement, shows us how a business performs over a period of time, usually a quarter or a full year. Okay, so for example, you guys know that many companies, in fact, if they are publicly traded companies, they definitely need to report earnings, and they do so on a quarterly basis. Whenever they report earnings, they release a report, which is the 10Q, all right, which you can access on the company's investor relations tab. I will show you how to do that as well. But that quarterly report will show you the income statement over that period of time, right? So it's the quarterly income statement. And typically when they release those results, you can see the quarterly updates right here. Many stock analysis tools will, stock analysis platforms like this one will show you the annual numbers, the quarterly numbers, and the trailing 12-month figures. So the annual numbers, they zoom out a lot of the noise, right? So they tell you, for example, the revenues, in other words, the sales the companies generated last year in 2023. But we will use, for example, the quarterly metrics to really zoom in on the company's financials and see, for example, if this quarter in particular they have turned the corner to profitability, if margins are improving right from the last few quarters. So it allows you to zoom in on the company's record, right? And then we have the trailing 12-month figures, and these are the numbers that I typically will pay more attention to. So what's the trailing 12 months? As you can see right here, the trailing 12 months or last 12 months refers to a rolling 12-month period of financial or performance data continuously updated to reflect the most current results. Okay, smoothing out seasonal variations and providing a more up-to-date view than just last fiscal year. All right, so whenever I'm doing, for example, evaluations, I always use the trailing 12-month figures typically. All right, perfect. So let's move on, and now let's start by covering our income statement right here, what's also called the bottom line. But let me just show you this. Okay, so the income statement answers a very simple question. Does this business make money, and how did it do so? At its core, the income statement tracks these things. We start with revenue, which is also called the top line. Whenever you hear analysts or myself talking about the top line, we are referring to revenue. Why is it top line? Because as you can see, it's the first item that shows up on the income statement, and so it's called top line. Then we have all the expenses that the business needs to incur in order to generate that revenue. Okay, so expenses, so the costs required to run the business. And last but not least, you have the net income statement, the net income figure, which is essentially what's left over. So it's called the bottom line because it shows up at the bottom of the income statement. All right, so revenue minus all expenses give you the net income or net loss. If the business is operating at a loss, it will show you as a net loss, and the number, of course, will be negative. And so the easiest way to think about this is the income statement is the company's budget, but just at a business scale. All right, so let's continue. And now look, we have revenue, and then we have the cost of revenue. What is the cost of revenue? Cost of revenue refers to direct costs. Refers to direct costs associated with producing and marketing the company's products or services. Okay, again, you have to understand which industry the company operates in, because not. For example, Lululemon has different cost, has different cost of revenue, right? The components are different than those from Southwest Airlines. It's a different industry, all right? So, what are the direct costs related to producing the product that Lululemon puts out? And you can see, if you want a detailed breakdown of these costs, all of that is listed on the annual report, okay? But you can see, for example, if I go here, Lululemon's cost of revenue primarily includes expenses for product sourcing, manufacturing, and distribution logistics. Okay, covering the direct costs to create and get their apparel and accessories to customers, right? Raw materials, factory overhead, and so this is what includes. My business, for example, the Like a Tortoise business, we run a coaching business, and so my direct costs have more to do, for example, the cost of keeping Skool, of running the Skool platform, right? That's a direct cost because I need that to create content, and it's a direct cost, right? But for example, hiring new coaches to teach you guys, that would be a direct cost as well, right? So these are the direct costs that are related to running the business. Cool. So let's continue right here. Nice. And so when you subtract cost of revenue from revenue, you get to the gross profit. Okay. And if you divide the gross profit by the revenue, you get what? Gross margin. So what the heck are margins? Margins are very important, and they are another thing that I also aim to look at whenever looking at the company's income statement. And for example, in a stock analysis tool like this one, you can get to the gross margin figure by going at ratios. And you can see, well, actually, I think they have it right here on the income statement. Yeah, right here. So look, gross margin. Okay, so to calculate the gross margin, you just do the gross profit divided by revenue. And what are margins? Guys, this helped me a lot initially. Think about margins as a percentage of revenue. That's what they are. So we start with revenue, we deduct the direct costs, we get gross profit. And then we divide the gross profit by revenue to get the gross margin. All right. And then if we deduct the indirect costs from the gross profit, in other words, the overhead costs, which include the selling and the selling, general and administrative costs, the amortization of goodwill and intangibles and other operating expenses, we get the operating income. And if you divide the operating income by the revenue, you get what? The operating margin. What you will notice is that the higher the margins, the better, because it means the business is more profitable. Okay, the lower the costs that are necessary to run the business, the better. And ultimately, what we will really want is to see higher net margins. After we then deduct the taxes and the interest payments on the debt, as I will explain to you, you will get to the net income. And if you do the net income divided by the revenue, you get the net margin. So let's say the net margin is 20%. And let's say the revenue the business generates is £100. What this means is that it means that £20, it means that out of those £100 in sales, the business translates £20, it converts £20 in pure profits. All right. So the higher that percentage, the better. That's what we want. Okay. So we discussed all the direct costs. Within the operating expenses, they include the research and development costs, which is called the R&D, research and development. You have the sales and marketing costs, right? So the S and sales and marketing, so the S and M, and then you have general and administrative costs, which is G and A. These are all part of the operating expenses, and you can think of things like utilities, rent, salaries, so on and forth. Okay, marketing costs, all of these things. Cool. Once you deduct that you get to the operating income, right? Cool. And then you can see other things like, for example, the EBIT, which is earnings before taxes. This is also called the pre-tax income. How do you get that? You take the operating income, as you can see right here. In fact, you get the gross profit, right? And you simply subtract all these expenses. And that and that will lead you directly to the earnings before taxes. We want to see earnings, but the only thing that we want to exclude are taxes. So we add those items. All right, cool. And you can see, look, pre-tax income, earnings before taxes, pre-tax income right here, right? Look, it's the same thing in this case. And you can see, look, you just do net income plus income taxes, and this is what you have. What's very cool about this analysis platform, these stock analysis tools, is that if you hover over them, they give you insights into each of these metrics. So it's not like you will be completely in the dark. Okay. But yeah. All right. So then we have the income tax expense, right, which you can see is the amount of corporate income tax that the company has incurred during the fiscal period. And then we have the net income. And what is the net income? You just do the revenue that you can see right here, minus all these expenses, and you arrive at the net income. what's also very cool then is the income statement will also show us the number of shares outstanding. All right, and we are looking for the diluted shares outstanding, because this, as you can see, is the total amount of common stock that will be outstanding if all stock options, warrants, and convertible securities are exercised. This is the number that we will be using to divide our net income. And if you divide the net income by the shares outstanding, you get the earnings per share. Because we are shareholders, we are always interested in per share figures. They are not the only thing that matters, okay? But per share figures are very important, because think about this. If the management team is issuing a lot of shares, they are diluting existing shareholders, and our piece of the pie shrinks over time. We don't want that. All right, we want our piece of the pie to get larger, and so they should be buying back shares over time, so that our share of the company, our percentage of ownership in the company widens over time as well. Okay, all right, so we've discussed the most important aspects of the income statement so far. Key important things. One here doesn't tell you much. So what we are after is a track record of across several years, right? So we want to see a track record of profitability and consistency in the numbers. So in the case of Lululemon, if I hover over this, you can see that revenues have been consistently growing over time. That is a positive, okay? Same thing, look at gross profits. They are growing over time. So look, the cost of revenue is actually, in fact, let me show you this. The cost of revenue has also been growing over time. And you can see how the revenue growth has been accelerating. And so the gross profit has been decelerating as a result of that, okay? So it's like, yes, we want to see that revenues continue to go up, but watch out if the cost of revenue is growing faster than revenues, because this will impact our gross profit. Okay, cool. Same thing here. So in terms of operating income, we want to see operating income going up over time. And you can see that in the case of Lululemon, there has been a dip here recently since March 4th, 2025. Okay. And this happened because operating expenses, as you can see right here, number one, because you can see that revenues so the growth of those revenues has slowed down, but you can see that the operating expenses continue to expand as they continue to grow internationally. So watch out. This is important for us, guys, because we want to see that operating income grows at a faster rate than operating expenses. All right, this is going to be important. Otherwise, our operating margin is going to be impacted, and management can control operating costs more than they can control cost of revenue. Okay, cool. Another thing that I missed in that I need to talk about is the interest expense on the debt. In this case, it doesn't appear here because Lululemon doesn't have bank loans, right? So they are debt free. But when the company borrows debt, they have to pay interest on the debt. And that will show up on the income statement as well. Why is that important? Because we want to make sure that the company generates enough profits, right, to cover those interest payments without defaulting on them. Otherwise, that would be a significant red flag. Okay, awesome. And so look at what happened to shares outstanding. Typically, I want to see this thing coming down. That would be good. It means the company is buying back shares and so they are reducing the number of shares outstanding. I like that. And then in terms of the earnings per share diluted, we want to see this going up. But here is the thing. If you only focus on earnings per share and not net income, I mean, I think you are doing things wrong, because if a company, let's assume a company does not grow net income, that's a red flag, because they should grow their earnings. But if they are doing a lot of buybacks, even without growing net income, earnings per share can actually increase over time, and this will give you the impression that the company's profits are also growing. So always look at the net income and the earnings per share as well, okay? In the case of Lululemon, I can see that for example, look at this. Okay, look at the earnings per share growth right here, and look at the net income growth. All right, so they have been growing. Now, granted, net income as the growth of earnings has collapsed substantially as a result of the headwinds that we already discussed here in former videos. But and so did the earnings per share, but not by much because they are doing buybacks. Okay, and that's why, for example, earnings per share has grown by 4.45%, while net income has grown by less than 0.5%. Okay, cool. So other things that we need to point out that I want to discuss right here that I may have missed. Let me go back to my document right here, and then I will show you Southwest Airlines. So we discussed that, right? What the income statement is, what the income statement tells us. So the core question again, guys, is can this business consistently generate profits? And are those profits improving in quality over time? This is important. So explain that the income statement answers, so the income statement answers three fundamental questions. How does the company make money? How much of that revenue turns into profit? Okay, we discussed that. You can see that by looking at by looking at margins. And how stable and repeatable is that profitability over time? All right. So one here tells you little. I would say almost nothing. It means nothing. Patterns over 5 to 10 years matter a lot more. Okay. And by the way, something that I forgot. The most important margin, if you ask me, the one that will really tell you the durability of the company's moat over time is operating margin. And let me explain why. You need to understand what operating leverage means. Operating leverage means that the company, as the company grows its revenues over time, it's able to spread out its costs over a larger user base. And so what happens is the company grows revenue at the same time the cost of revenue. Exactly. So at the same time, the company is growing its revenue. At the same time, the operating expenses are either growing slower or coming down, in which case you will have operating leverage. And this happens, for example, with businesses that are quite capital light. Think about SaaS companies, software as a service companies, right? Once they have the software implemented, then the costs that are necessary to actually scale are minimal. Yeah, so they generate revenues, and those revenues grow faster than the costs that are necessary to grow them, right? To grow the business, and so they achieve operating leverage over time. So, for example, one of the things that I liked, just to show you right here with PayPal, right, is that if I go here to the operating to the operating to the operating margin. Where is this? Hold on a second. Operating income. This is okay. Operating margin. Where is this? So I have gross margin. If I look here at the operating margin, you can see that ever since Chris, the new CEO, took over, the company has been achieving more operating leverage. Exactly because they have been controlling a lot of their costs as well, their operating expenses, while the revenue has been accelerated from the last few quarters. Okay, so this is positive. Cool. Let's go back to our document right here. So yes, 5 to 10 years. So revenue is the engine of the business. So top line, revenue growth versus revenue quality. Like a Tortoise lens, focus on consistency over speed. I want to see consistency in revenues. And by the way, whenever you guys suggest a company that is growing revenues at 50 or 60% per year, I don't like that. And the reason I don't really like that, guys, is because number one, that tells me that the company is probably is still very small, in all likelihood unprofitable. But the most important thing is that those growth rates will attract a lot of competition over time. And so I don't really like that. Okay, I like to see, for example, 20%, 25% maximum growth. Other than that, I think you will attract a lot of competition because those growth rates are simply unsustainable. But well, I mean, it's common among smaller companies. So we focus on consistency over speed. Steady growers are so much better than boom and busts. Revenue growth that comes from the core business, not one-offs. Okay, revenue growth that comes especially from organic growth instead of just acquisition. Some companies only grow revenue by acquiring other businesses. That's not okay with most companies because most of them actually just acquire other business for the sake of growing the revenues, but then there are no synergies in that destroys profitability and shareholder wealth or shareholder value over time. Geographic and customer diversification. Understand where those revenues are being generated. So, for example, in the case of Lulu, I know that 70% of the revenues come from the Americas, which include North America and Canada. And so you have to understand the geographic split as well. All right. Key questions to ask: is that growing steadily over many years? Does growth survive recessions or downturns? This is important. How did the company behave in past downturns? Right? Do they have pricing power? This is important. Guys, this is very important as well. How do we determine whether the company has or not pricing power? Gross margins. All right. If the gross margins are expanding over time, this is a great indication of a moat because it means that the company is capable of raising prices without losing customers. And so we want to see that. If we see gross margins growing alongside revenues, even better. Okay, very, very good. So let's continue right here. Some red flags: highly volatile revenue, growth driven primarily by acquisitions, heavy reliance on a single customer or region. Think about a company that generates 60% of its revenue from a single customer, a single client. Could that be a red flag? I mean, yes. What happens if that client goes away, right? Then you will see revenues plummeted, which is definitely not ideal. So cost structure, how the business is built, what to cover. We discussed already cost of revenue, cost of goods sold, operating expenses, R&D, marketing, admin. Explain that great businesses have, you need to understand that great businesses have structural advantages that keep costs low. Benefit from operating leverage as they scale. We touched upon that. And so the key focus areas for us are stable or improving gross margins, disciplined operating expense growth, evidence of scale benefits over time. So, for example, do I like to see that, let's say, revenues are growing at 7%, but then you see the SG&A expenses, in other words, the operating expenses, growing at 10 or 11%. Is that good? It may not be, guys, okay? Because again, that will affect margins. And so the better metrics for you to look at just to track this over time are margins for sure. All right? Fantastic. Let's continue. And that red flags: rising costs faster than revenue. Here we go. Permanently declining margins, aggressive cost cutting that hurts long-term moat. It's okay to be wise with regards to controlling costs, but if the company is cutting costs substantially, I mean, seriously, how are they going to be able to continue to grow their revenues over time? Right? So it's necessary to keep some costs as well. And for example, if a business like Lululemon, which is opening new stores all over the world, they need more staff. And so, of course, they will always need to grow their operating expenses as well. Okay. Gross margin. First signal of business quality. Why it matters? It reflects pricing power, brand strength. How many businesses have tried to increase their prices, but then they had to reverse course because they were losing customers? That is a red flag. Okay, that is a red flag. That shouldn't happen. If it happens, it's because the business doesn't have a competitive advantage. So what are we looking for? High and stable gross margins usually indicate a moat. Improving margin suggests strengthening competitive position. Compare margin against peers, not in isolation. So far, I've been telling you about the margins that the company has relative to its history. But what does that tell you in terms of how good they are relative to their competitors? You have to do that analysis. So, for example, I don't think I have all. I actually do. So look at this, guys. Okay, I'm sharing the document right now, and when I discussed Lululemon in one of my last videos, I was comparing Lululemon across its main publicly listed competitors, right? And when I did that, you can see that I compared them across, I compared them relative. So I compared their margins, I compared their debt levels, I compared their capital allocation skills, and I compared them the past growth. I compared them I compared the growth projections. Okay, the valuation levels. So you have to understand these things. And for example, you can see that in the case of Lulu, this number has come down because of tariffs. So now right now it's at 54, about 54, I think, or 55. No, actually, is it 55? Let me go back here. Hold on a second. So let's go to quarter. Oh, by the way, this is a very good example. So for example, you can see if I go to gross margins, it tells you 58.41, but this is the trailing 12-month figure. However, in the most recent report, which is the last quarterly report, you can see that these margins have come down because of tariffs, because tariffs are denting the profitability. And so a more accurate picture of the gross margins is you have to go to the quarterly section, and you can see that the gross margin has declined from this 58.50 all the way down to 55.57. Okay, so this number that you'll see right here, bear with me, this number is not updated. So it's not 58. This is the trailing 12-month figure. It's actually 55. But and so despite the drop, the competitors have also come under pressure because effectives, while tariffs don't affect every one of them equally, they still affect all of them. Okay, so yeah, look how it's attractive even at 54, and even assuming none of the other of the competitors' gross margins have come down, look how competitive their margins still are relative to competitors. That is staggering, right? What it tells me right here, guys, is that Lululemon, unlike many of its competitors, can actually absorb a lot of those tariffs costs without passing on costs to customers, which they will eventually do as well. But they have some cushion here, which is fantastic, and that's one of the reasons why I bought them. Good. Another thing that I want to discuss. Okay, so we discussed that. Understand so against peers, and understand the margins of the industry itself. Very important. So note, software and strong brands often have high margins. Commodity businesses usually don't, and this is where you will see, for example, that very cyclical companies that are very capital intensive as well, they typically have terrible margins. And for example, most retailers actually also operate on thin margins. Think about net margins around 3 to 4%, which is very, very low. I don't really like that. So I like great margins. Operating margin, the true test of discipline. What it shows, operating margin tells us how efficiently management runs the business. Remember when I told you that management has a much greater control over the operating margin? Over the operating expenses, where this is what I mean, right? So what are we looking for? Long-term margin stability, gradual improvement over time, ability to remain profitable during tough periods of time. Yeah. For example, notice how Lululemon, notice how their revenues actually continue to grow while the revenues of companies like Nike actually shrunk. So Nike lost business, revenue continued to expand business despite the headwinds. Good. And then the red flags right here. All right. Key questions to ask: does the business stay profitable in downturns? Are margins sacrificed recklessly for growth? Exactly. One of the reasons why I like to invest in businesses with high margins is because think about what will happen in a downturn. In a downturn, the business can be forced to cut costs, or yeah, because for example they lose customers, and if that happens, and if the business is operating on thin margins, who do you think has a highly likelihood of succeed? The one that operates on thin margins, or the one that operates on high margins that can actually absorb those costs? There you have it. Okay, good. Red flags: wild margin swings, profits that only exist in strong economic cycles. And then we have earnings, net income, useful but incomplete, as we will talk more about. What to teach. So net income is accounting based. It can be distorted by one-off tax changes or accounting choices. So what are we looking for? Never rely on net income alone. Always cross-check with operating income and also free cash flow, which I will cover in a separate video when I tackle the cash flow statement. Note, a great business converts accounting profits into real cash. And that's why one of the things that I'm after whenever I'm analyzing a business is I want to see high cash conversion ratio. What the heck does that mean? You just do the operating cash flow, which is the cash the business generates from operations, which I will talk about later. You divide that by net income, and you can see that in the case of Lululemon that I'm showing you right here, the cash conversion ratio sits at above 100%, which means that most of the company's profits are actually converted to operating cash flows. This is very good. Okay, this is exactly what you want to see. Any cash conversion ratio above 100 is very positive. And so stay away from companies with very low cash conversion ratios, because, I mean, if that is the case, you really need to understand why they are not converting the majority of their profits into cash. Over time, profits and cash should correlate. But remember that cash and profits are not the same thing. A business can generate great profits but still go out of business because it runs out of cash. It's the same with a person. Imagine me, even if I earn 100K per month, I can get to the end of the month and have nothing. Okay, even though I'm paid 100K per month, because I don't control my costs. That is the same. That is the same way for a business. It's how it works with a business. Um, okay, so let's go back right here. Uh, Earnings per share, while long-term investors must be careful what to cover. Earnings per share growth versus real business growth. Impact of share buybacks and dilution. We discussed that. What are we looking for? Earnings per share growth is only meaningful if revenue is growing, right? Margins are stable or improving. Share count is shrinking responsibly. What do I mean? I mean that I don't like them to buy back shares when they are trading at expensive valuation levels. In that case, they can destroy shareholder value because they are buying shares that are overpriced, right? And they would be far better just allocating that money towards higher return investments. Red flags: earnings per share growth driven mainly by buybacks. Red flag here. Heavy stock-based compensation. Okay, don't like that as well. uh, because if they, yeah, I mean, we can talk more about this, but if they are doing a lot of stock-based compensation, then that will create dilution. And this is very clever, because they will tend to do many times is they will use buybacks to offset all the stock-based compensation they are doing. Very clever. I mean, those guys, I mean, pay attention to guys that are not, whose values are not aligned with yours. Cyclicality and durability. It's important to distinguish between cyclical earnings, right? Commodities, heavy industries, and durable earnings, consumer staple, strong brand software. Even though software, I'm staying away from it. I'm staying away from software because I just don't know how big an impact AI will have on the software space. So I just avoid it. But of course, the some software companies, they are capital light, and you will see that straight away in the numbers as well. So I prefer businesses that earn money in good times and bad times, and that's why I don't like companies whose profits are tied to commodities. Think about precious metals, right? I mean, some of these companies have done nothing for decades. Why? Because they depend on how well the metals will perform as well. So now with the metals going through the roof, they bottom lines and are look much better, but still it may be that when these metals crash, which they will at one point, then these companies may be will be significantly affected the same way. Okay, so I like there will always be some volatility, right? Some cyclicality, but not so much in these companies here. All right, so multi-year analysis, the Tortoise advantage. We want to estimate. We want to check 5 to 10 years of income statements. We want to ignore short-term noise. Revenue compounding, margin consistency, fewer surprises over time. Note, anyone can analyze 1 year. Great investors analyze decades. And so you have to understand these things. Common income statement mistakes to avoid. I've made all of them, so pay attention. Looking at 1 year only. Obsessing over EPS beats misses, right? Because this causes you to focus on the short term at the detriment of the long term. And you should have a long term perspective on the company. And another one, ignoring margins. Failing to understand the business model behind the numbers. Guys, I can't stress how important this is. Ultimately, it all comes down to understanding the business. Because if you can't understand how the business makes money, you will be able to tell if the earnings are growing or not, but you will have a harder time understanding whether that consistency is going to be durable or not. You have to understand the business. And so, for example, in the case of Lululemon, what I will do straight away to understand the components of the revenues, to understand each of these lines in better detail, you can go to the company's website. You can download the last annual report. Okay, you just go to the investor relations section, download the annual report, and you can see that the income statement will appear in that report. Okay, you can see right here. This is how it shows up in the case of Lulu. Look at that. All right, so we have net revenue, cost of goods sold, gross profit, every single line that we discussed. Okay, ending with the diluted weighted average number of outstanding shares right here. Okay, and they give you 3 years worth of financial data as well. Okay, fantastic. By the way, notice how these amounts are in thousands, but this is actually billion. Okay, so it's 10 billion, not 10,000. It's like 10 billion. Okay, good. My goodness. Let me just take a zip right here. Okay. I think we addressed some of the most important things on the income statement, in things that I'm always on the lookout for. And yeah, guys, I mean, this is what I'm really after. I don't think I have anything else that I want to flag. Let me check. Always do your own due diligence, and you make sure that you become comfortable with the financial statements. Okay, so guys, I hope you've managed to derive value from today's video. If you did, please smash the like button, because it took me a long time to actually put this content out. Of course, but I want to detail exactly what I'm after whenever I'm looking at the income statement. And let me know in the comments below if you want me to put out more of these videos. And but hopefully you'll be able to revert to this video whenever you want to understand a bit more about each of the items that show up right here, right on the income statement. So have a great one, guys. Stay tuned for more.